Let's take a look at American Airlines and we'll run this deal through the model and see what it comes out to be. So the market cap is 7.9 billion. So we'll put that in. And then the stock price is 1865. So now we know the shares outstanding because it's just a market cap divided by a stock price is the shares outstanding, 424 million shares. And to calculate the intrinsic value of a stock, we have to estimate the future free cash flows of the company, then discount that number back to today's dollars. That way we have the value for the entire company. Then we divide that number by 424 million, the shares outstanding, and we get the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's higher or lower. Now let's get the actual free cash flows. We'll go to the financial section in Yahoo, go to cash flow. And free cash flow is the cash that's remaining after an operating period. So after running a business, this is how much cash they have left over. So you can see 3 out of the 4 years, they lost cash. So they had to take on more debt, which isn't a good sign. Now let's look at net income. That's on the income statement. That's a profit and loss for a given period. And you can see they have positive net income, but negative free cash flow. Because net income, there's non-cash items on the income statement that can affect the net income. That's why we estimate free cash flow to figure out the value of a stock and not net income. Okay, so now we have the values in the model. And it does make it more difficult to have negatives because a normal free discounted cash flow model can't really work with negatives. It needs mainly consistent positive numbers. But I altered the model a little bit to make it fit. But we need a capital structure of American so we know what the discounted cash flow is by. So they pay $1 billion in debt, interest on the debt. And now let's see how much debt they have. We'll go to the balance sheet, go to liability section, and they have 2.8 billion of current debt. That's debt due within 12 months. 21 billion of long-term debt. That's debt due more than 12 months. And they pay 4.5% interest on the debt. But interest payments are tax deductible, so let's find out their effective tax rate. We'll go back to the income statement. The income before taxes is 2.2 billion. And then the income taxes is $500 million. So they pay 25% in taxes. So the cost of debt is 3.37%. That's pretty good, but they have so much debt. 75% of the capital structure is debt. It's a really leveraged company. That's a really risky investment when they have so much debt. Now let's see how much equity they have. So the beta is the volatility of the stock is 1.64. So to calculate the cost of equity, we use the CAPM model, capital asset pricing model, and the cost of equity is 15%, which is a lot lower than the cost of debt, which is 3.4%. Because debt is a lot safer than equity, because in the event of a default, the debt holders are paid first, and then the equity holders. So the WACC, the weighted average cost of capital, is 6.2%, and that's what we're going to use to discount the cash flows. And that's just a combination of cost of equity and cost of debt. So let's see what the values are. So we estimated future free cash flows for 4 years. Then we did a terminal value, which is all years past year 4. And then we discounted those numbers back to today. And we got a value of the company of $6.1 billion. When we divide that by 424 million shares, we get a stock price of $14. And it's trading at almost 19. It's up pretty nicely today. So you can see, according to the model, it's a sell. It's trading at a 30% premium. We're valuing the stock at $14. Now, even though you see one model, I actually have 4 models embedded into this one model because based on the type of company and the type of financials, I have to figure out which model fits the best. So the model I use for this company is it's a model I rarely use, but in order to come up with a positive stock price, I have to use it, because if I didn't use this model and I used the other three models, the stock price would be negative, which doesn't make sense. There's no such thing as a negative stock price. So it's really hard to value companies with such poor financials. That's why when you do these types of calculations, a lot of assumptions goes into it. And I often get asked, like every day, through Facebook or YouTube, can you send me your model? As if I send them the model, they're going to be rich. They're going to know what to buy. There's just so much you have to do after you enter the numbers. You have to figure out how the numbers move, and it's just a lot of like, it's really challenging to know which model to use and to even know there's multiple models. But I thought I'd give you a little more color on that. Maybe one day I'm going to do a live stream, and then I could kind of dig into the model more to show you. Now let's look at the ratios. And the good thing about my channel is I've now done almost 100 companies, so I have some more information to compare to other companies, which makes it a lot more valuable, the videos, I feel. So we're going to look at some of the common ratios, but we need to get some info from the balance sheet. So let's we'll go back to the financial section. We'll go to the balance sheet. I need the current assets. That's 8.2 billion. The current liabilities, 18 billion. And the equity, negative 118 million. So let's talk about these. These are probably the five most common ratios. But anytime you look at ratios, always remember you have to compare it to companies in that sector. Some people compare like Apple to like American Airlines, and you can't do that because different companies have different ratios and it won't make so much sense. So compare it to similar companies and also compare the ratios over several quarters. So the PE ratio is the most common. That's the price over earnings. Okay. So their PE is about 5. That's really good PE. PE of 5 means investors are willing to pay $5 for $1 profit. And the lower the better. I generally look for 15 or lower in a company before buying it. Now, in order to get a lower PE, either the stock price needs to get lower, which is the reason it's so low, the PE. It would be a lot higher a few months ago when the stock price was like 60 bucks. Another way to get a lower PE is you need higher net income. The company has to report higher net income or lower shares outstanding, because the calculation for PE is stock price over earnings per share or stock price over net income over shares outstanding. So once you understand the formula, then it'll make a lot of sense why like stock buybacks is a great way for a company to lower their PE, because it lowers the shares outstanding. And then depending on how a company records depreciation, that can also affect the PE ratio. And that's why the income statement, there's so much flexibility in what you can do with it. So you can really kind of change numbers around and make it look much better than it really is. So that's why you have to really look at a lot of different financials to understand the company. So it is a good PE. Let's move to the price over sales ratio. And that's just the stock price over the sales per share, or the stock price over sales over shares outstanding. And I look for under 2.2 in a company. And to get a lower price over sales ratio, and you want a low one, you don't want a high one, a lower stock price helps, or higher sales, or lower shares outstanding. So stock buybacks, that's why companies have done so many stock buybacks the past decade, is they're trying to really aggressively make their ratios look really really great, much better than their competitors. So if like United Airlines is buying back stock and its PE is lowering, then American has to start doing the same thing, and Delta has to start doing the same thing in order to compete to get to the investors. So it's generally a low PE, a PS is an undervalued stock, and a high PS is an overvalued stock. Price to book is the stock price over the book value. The book value is your equity or your net assets. Book value is your total assets minus your total liabilities. This is a rare case where it's negative. It shouldn't be negative. That's just because they have negative equity. According to the balance sheet, they're worth nothing. They're worth even less than nothing. They're worth negative $118 million, according to the balance sheet, that is. So this is not a good sign when a company has negative equity. So you can't really get an accurate PB ratio when it has negative equity. A current ratio is a current assets over current liabilities, and current assets are just assets that can be converted to cash within 12 months, and current liabilities are what you owe within 12 months. So if it's under 1, the current ratio, that's really bad. That means you can't even cover your short-term liabilities. That means you won't even be able to pay all your suppliers and vendors and all your debt holders this year. So what happens? They just take on more debt, or they go bankrupt. That's only 2 options. Or I guess alternatively, if one of your lenders lets you pay them back in like a few years from now instead of this year. That usually doesn't happen. That's generally what happens during bankruptcy process, is that you are able to negotiate with your creditors and get better terms. That's why people go bankrupt, to get better terms on their debt. And so a current ratio below 1 is terrible, and it's just the writing's on the wall with this company. It looks like it's headed that way towards bankruptcy. I don't see how it could not, unless somehow the market recovers and everybody starts flying again. But that's unlikely. And the ROE is their income over equity, and that's negative in their case, and it shouldn't be negative. But since they have negative equity, it gives a kind of a poor indication of the number. You want above 20%. That's actually what I look at. And now I'm going to show you, now that I've done United and JetBlue, I still need to do Delta, but I could compare their ratios, and then you can see this is what you should be doing, comparing them to similar companies. So the PE is good for all the companies. It's all below 15. So is the price of sales. It's all strong. The price to book is really good for JetBlue and United, but it's negative for American, so that's obviously a bad thing. The thing that, even though these numbers look good, you can't just say, oh, PE is on a 15, so I'm investing. That's what a lot of people do. And you need to look at other numbers and other ratios and the financials too. But their current ratio is below 1 for all the companies. At least JetBlue is the best of the companies. It's just really a bad sign. And if they all go bankrupt, it wouldn't surprise me. But who knows? And that's up to you if you want to invest in these companies. So let me know what you think in the comments. I usually don't give this much color on a company, but I'm happy to go into more detail and depth. Thanks for watching.